Hello and welcome to our second podcast. This is Wealth Transparency. I'm Ed Butowski, your host, and I'm joined by Andrew Tang, investment strategist from Turner Financial Group, Michelle Connell, who's with Portia Asset Management, and Lex Nikpour, who's with Ethos Financial Group. Each week, what we do is we try to take headlines and subject matter that really don't make the big headlines and discuss what people should do as a result of these situations with their money. So, to start off with, Andrew, let me jump into this with you right away. And hedge funds are the big animal out there. They're the ones that really drive markets. People are shocked at how little individuals play in the overall market. It's usually endowments and foundations and hedge funds that move markets. But the hedge funds portfolios have shifted recently. Can you address some of those shifts and what we're seeing in the overall market?
Yeah, I think thank you for it's a great question, and I think the shift has been happening since November of last year. As I was alluding to many of our clients, is that a lot of the hedge funds, big money endowment funds, they have not really participated in the recovery rally of last year since November. So many of the large money, smart money, they have been more defensive in their posture and in their portfolio allocation. And throughout the year, many have reinvested, dipped back into the market. But right now, all that's going on relating to trade tensions, for example, the dollar weakening, and then you also see the Magnificent Seven or Magnificent Six, the large cap. They really have run up to their valuation to high levels, and so it's their way to diversify and to take risk off the table. One of the things that they do pay more attention to than the individual investor is that they want to put more assets into non-dollar based companies. That's in response to the dollar weakness, and also understanding the market is, or the rally is, broadening out. So a lot of the layers of this growth, for example, the energy infrastructure, the cloud infrastructure, and the chipsets, all that needs to be diversified. We see strength coming back into industrials, also financial, under the current environment. So rotation out of tech, take that profit, get out of the momentum names, de-risk, and putting into other names that are in broader market makes more sense.
So Lex, a client asked me a question the other day about was money leaving the equity markets, the mega cap, and moving into gold and silver. And my question is, do you think hedge funds are doing this, or are hedge funds sticking with their strategies and not going from equities over to commodities?
Well, I think broadly, the hedge funds are going to have, generally speaking, they have multi-strategy. I mean, we can use one of the biggest names that's out there, such as Bridgewater. Ray Dalio has been investing in commodities for decades now as a hedge to equity exposure, but obviously geopolitical risk. And I think that's where you've seen that rally start. I mean, there are a lot of signals that also just point to a broader rally in commodities. I mean, we might be in the third or fourth inning of a broad commodity secular bull market here. So I don't think, I mean, maybe partial rotation, but I think, as Andrew pointed out, it really has to do with where's the value in the market? Where have we had extended multiples in a long time? It's been in those headline catching, names in the Mag 7. And so I think it's really just those hedge funds looking for places where they can go extend their theses and their processes to go extract value from the markets. And so I think, to that end, silver, gold, other commodities, copper, they've had the rally of last year, but I think that's just, we're in early innings of that. It's amazing how much money flew into hedge funds in the most in 19 years.
So, Michelle, when you look at the overall landscape and you think about hedge funds dictating a lot of the direction, which hedge funds or what part of the hedge funds do you focus on, and what kind of rotation are you seeing?
Well, as Lex said, there's been a lot of money going into the hedge funds, and I think that's for two reasons. Number one, it's valuation. We've had so much concentration, and the hedge funds are taking advantage of where those pockets of over and undervaluation are. And I think it's also the factor that the investors that have been allocating to alternatives are getting frustrated with the lack of liquidity, especially on the private equity and venture capital side. So they're looking to the hedge funds, especially those that are adept at tactical trading, the over and under valuation. And from what I read today, which I did not realize, some of them have been really smart and they saw this software trade coming with the software names are going to be slammed from AI, and they've been short those names. And they've made a lot of money in that particular trade. So of course, it's when you look at the dispersion in hedge funds, it's huge in performance. I'm saying that as someone who came from a Chicago shop. We did private equity well. Our hedge funds were horrible. So be sure you look at the amount of dispersion with the managers, because you can have those that do very well and those that do poorly, even though when you're looking at the median performance, like in the past few months, they've done very well.
So when you say the AI trade versus software, what you're saying is that a lot of firms are realizing that they can get from AI what these big software companies have been doing. So there's a fear that the software companies are going to become somewhat obsolete. Is that correct?
I would say that there's a lot of emotion and fear there. How much is actually the case in terms of AI being able to supplant or overtake what a software firm does? And when Anthropic came out and released some of their advantages that they've been able to make recently, that's where the software trade, everybody unloading their names went really downward. You had that almost catching the falling knife. I didn't look at them today, but I think since November, if you look at an ETF software in general, it's probably down about 30%.
Wow. Well, let's.
Can I touch on that really quickly too? I mean, just to add on the back to that, not to overemphasize, but I think what's important to note here too, like for the average investor, is to remember like how emotional these trades get too, right? Someone comes out and that volatility is super obviously for those large institutions and hedge funds who are taking advantage of those from the shorts perspective, but also for your everyday investor who's probably more of a long-term investor. I think it's important to remember that these visceral reactions tend to get overblown. And, the long-term effects of that industrial change with AI, while maybe it's a shorter run from adoption than maybe other industrial cycles in certain aspects, there's still a long-term play, which a lot of CEOs have come out, presenting earnings this week and talking about their forecasted expectations from business. They recognize that AI is having an impact, but they also recognize it's going to take time to really understand the implementation and that true initial feeling that investors feel of this massive offset that jobs are going to be gone tomorrow, because they're not. But there will be this tapering down over time.
Yeah, there's been a lot of clients have asked me about finding these very young AI companies that are not Nvidia, that are not, Meta or Google and Amazon, that, and that's a very difficult thing to find. I might ask all of you if you have any nascent companies that you really like, but I want to shift our attention to gold and silver, because that was really the big headline a couple of weeks ago. And now it's a big headline. I have a client who was really happy and then sent me an email saying, why was my portfolio down? Why were these stocks down 30%? I'm thinking, well, they were up about 100% and now they're down 30%. But the whole solution here, or the question is, what is happening with gold and silver? And Andrew, why don't you take it from there? Are you advising clients to buy gold and silver?
Generally speaking, again, we're using it as a hedge, and we limit our allocation to, I think I said it last time, anywhere from 5 to 15%. But even within that bucket, we have institutional clients that have set up specific separate accounts just to manage gold and silver. But gold we have seen from the recent highs, had we trade somewhere around, 17 to 18%, somewhere around there. but silver is the volatile one. So it went down 40% from the recent highs. I think there's still a place. I mean, for the long term, gold and silver will be meaning the long-term growth trajectory is still intact, in my opinion. It's just that the recent movement has been parabolic. And so, it's very easy to say, hey, once it goes parabolic, that's going to be a reversion to the mean trade out there. And sure enough, it is still out there. But there is still intrinsic value in gold, and it's an indirect relationship to obviously long-term inflation expectations, as well as the amount of debt in central banks and around the world. So these two factors alone will keep gold at its place, and precious metal, gold being the store of value, silver, there's utilization, and then there's some copper in there too. So copper and silver will be more of a function of long-term demand for data center and tech. And then gold is more of a store of value, in my opinion. So the long-term growth path is still intact, but this is just a short-term correction, reversion to the mean trade, in my view.
So let's add on to that a category that I don't like at all, which is Bitcoin. So let's look at gold, silver, and Bitcoin, and how are you positioning those with your clients?
Well, and I appreciate you throwing Bitcoin at the youngest one potentially on this call, albeit I'm probably not the best one to opine on this. And I would say that's probably due to my roots from, political science. And I have a difficult time with Bitcoin, and have from the beginning, candidly. Yes, there's a store of value there as well, just purely from supply demand. Really, the underlying technology, the blockchain technology, is a very functional one that has multiple applications. But from this idea of a currency without bounds, that's a huge risk to sovereignties. Where candidly, for sovereignties, that's just about everything. The value of their currency is where they stand on from a trade perspective. So I don't think, I think you're seeing the peeling off of the speculation in Bitcoin for sure. I think you're seeing folks taking profits from Bitcoin, and potentially those will be reallocated in, as we were discussing just before on this call, if there's some type of rally as this sell-off settles down, and you might see just those funds shift out of Bitcoin. And I mean, candidly, I prefer gold than to Bitcoin from a portfolio perspective of providing a somewhat similar, technically supposed to be uncorrelated asset, which has not been the case at all in the last 18 months, right? So I say good luck to those. And people are fanatical with Bitcoin, and I appreciate and understand their belief, and good for them. But I prefer to have something that you can touch, feel, has a store of value, multiple uses, and then I prefer businesses that actually produce revenue.
Yeah, and gold and silver and Bitcoin are always marketed, Michelle, as a store of value. But I don't know what kind of value they're storing right now, because they've all gone down. If you look at gold and silver, they trade, because of limit ups and limits down. If you understand trading on the exchanges, you can see that these types of commodities go way above where they should be with a limit up, and then limit down, they go down below where they should. So, what is your view on gold and silver and Bitcoin from that standpoint? Are you adding that to your clients' portfolios?
I'm in the same camp as Lex. It's really hard for me to feel comfortable with Bitcoin or any cryptocurrency here. I'm comfortable with gold and silver at the right price, but when you've had hyperbolic moves, which we have had for several months, it's really hard to step in here. And you've had a lot of ETFs now that also have been jumping on the bandwagon, and you have 3 times or 2 times the miners, and everybody wanted to get into that trade really quickly. And at the same time, as everybody was loading the boat, now you have so much outflows in terms of the ETFs, and Bitcoin's ETFs are their outflows are even larger. So I don't want to step in front of that train, especially for cryptocurrency. But I think owning gold and silver and metals as you can touch, and they do have a place in a portfolio. And you have a lot of central banks that More of them are trying to balance what they hold, stepping away slightly from US dollars, moving more towards gold. That's another reason to have it in your portfolio. But I don't think I'd be adding it here, but I think having a strategic allocation, like Andrew talked about, that's what I feel comfortable with.
Yeah, so my issue is with gold. Gold doesn't have any revenue. It doesn't have an ongoing
Yeah.
business, and it never has. And I don't understand, other than the demand, the desire that people have to own it, I don't understand the attraction to it. Can any of you address that?
Yeah, I mean, that is just exactly what it is. It's an instrument that in God you don't trust. It's a hedge. Yeah.
Yeah,
That is the in God you don't trust instrument. That's what you add to the
yeah.
portfolio, and that's why we add that as a 15% hedge, at most. Some people use the shorts to hedge their portfolio. I think that's silly. Um, yeah, I think that's really a good way to frame that.
So so let's look at consumer confidence. So there's something called investor sentiment, where when investor sentiment is at its lowest point, 12 months later you have 20% return historically on investor sentiment. But when it comes to consumer confidence, that's a very different animal than investor sentiment. So Michelle, can you take us through anything that you have about consumer confidence and how that relates to the stock market?
I think we're at a concerning point here in terms of consumer confidence. And behind that is people's fear about their jobs long term. And as we're seeing the jobs numbers come out, especially the lack of job creation, that consumer confidence number will probably continue to go down. And there's supposedly a mathematical point at which, if confidence is at a low point, then so many months later you head into a recession. Well, I don't know that that always works, but if we continue to see the confidence slide and we don't have job creation, at some point that's going to create less consumer spending and more people are going to be fearful of losing their jobs. And I'm going to go to the statistic that I read at the beginning of the year that 6 out of 10 large hiring companies have stated that they are going to have some form of layoff in 2026, and they're all leaning on AI. I think that's an excuse. I think it's an excuse to clean up what they have and maybe improve their margins. But all that comes together and impacts consumer confidence, and at some point it's going to have an impact, but it bears us watching that closely, especially with this lack of job creation.
Well, my wife will add to the number of consumer confidence because she shops quite a bit. But Lex, why don't you give us your viewpoint on consumer confidence and how that impacts the stock market?
Yeah, I agree with Michelle. It's something that needs to be watched really closely, particularly the U.S. economy being a consumer-led economy, and all of a sudden, that confidence drops out, and it can precipitate, pretty quickly and lead to certain second and third effects. I think what's interesting is just the announcement of layoffs. Amazon announcing about 16,000 layoffs. I think UPS was about 30,000. It was the most layoffs since '09, which, you know, back half of that recession, but a real time. I mean, just anecdotally, I mean, I remember I was in college at the time packing trucks at FedEx at 2 o'clock in the morning, and most of the gentlemen on my line all had graduate degrees to some extent because of how serious that recession was. And not to say that we're headed in that direction by any stretch of the imagination. It's obviously too hard to tell, but that confidence, when that wavers, those effects run deep, and it takes a while to build that back up, particularly in light of so many people feeling the effects, fleeing to safety assets, right? I mean, those start to tell you something about the psyche of the investor. So it definitely needs to be watched closely.
So, Andrew, we were talking before we started the podcast
Yeah.
about Europe and Germany being the largest economy and that
Hmm.
they lowered their growth forecast.
Yeah.
So, what's interesting is that they lowered it very small, but they didn't raise it.
Hmm.
And I think you have to kind of separate the two. But you said some very interesting things about car manufacturing in Germany and how it's being taken over by China, Volkswagen. Can you talk a little bit more about the economy of Europe and Germany specifically?
Yeah. The Europe continent is the third largest GDP area for the world. And Germany is the largest country, the strongest country with GDP wise, contributing inside the EU. Now, they didn't lower a whole lot, that's 1.4% to 1.3. But what's really interesting that is there's a massive shift in how their economy is shifting towards. Obviously, this is at a micro level too. This will shift their operations and their investments towards efficiency. And so, as an industry as a whole, as a country as a whole, they also see that as well. And it's really scary because it reminds me of the NAFTA agreement that the US had crafted under the Clinton administration, right? So, what I was talking to you about is that recently Volkswagen had contracted Chinese car manufacturer to make their EVs, but because they have, the Chinese are doing it quickly and cheaply, they do it so well, Volkswagen decided to extend that relationship to make gasoline car as well. So the mighty German car manufacturer is taking a pivotal step in changing the structure of manufacturing for that country, and that is something we definitely want to keep a close eye on.
Yeah, that's kind of amazing because Germany has always been positioned as the number one place to make cars, BMWs, Mercedes, and Volkswagen, so on.
Yeah, but the cost of labor, and the cost of goods made has been astronomical. If you think U.S. Has red tape and bureaucracy. How about 10x that? Trying to hire and fire somebody in Europe, it's like trying to go through a divorce. And I'm just, exaggerating it in a bit, but then I'm not. In Germany, they have lots of fiscal challenges. Even though the government is trying to stimulate, they're not seeing a whole lot of results. And then you have a flood of refugees, pouring all over Europe, eating up their, funds and their entitlement program. It's hurting a lot of the major, countries out there, G7, G20. Everybody pay their fair share, obviously. But this downgrade is just, I believe, is just the beginning. I think you're going to see more pain in Europe.
And then you're going to see some banks fail, and there's going to be a systemic event, and the whole world's going to crumble.
Well, I wouldn't go that far,
Nice, Ed.
Yeah. Merry Christmas.
Well, I want to thank each one of you, Andrew Tang with Turner, Michelle
Yeah.
Connell with Portia, and Lex Nikpour with Ethos. And any of you watching this, please feel free to reach out to any of these people and get advice from them. I really appreciate you doing this. And again, this is Wealth Transparency with Ed Butowski. Thank you.
Thanks
Thank
for
you.
having me.